When you look at Supermicrocomputer Inc., SMCI right now, what do you actually see?
Oh, that is the million-dollar question today.
Right. Because, I mean, are you looking at a falling trend that's just flashing these massive sell signals? Or is this a strong buy that the market is just completely mispricing as undervalued?
Well, it's basically the ultimate Rorschach test for the market right now.
Yeah, totally.
You can look at the exact same financial filings, the exact same chart data, and somehow come away with two completely opposing yet, entirely rational conclusions.
It's wild. But welcome to today's deep dive, everyone. Our mission here is to just cut through the absolute noise surrounding SMCI as of today, April 15th, 2026.
And there is a lot of noise.
So much noise. So we are pulling from real-time market data, technical charts, fresh analyst notes, and of course the company's latest financial filings.
Right. We really want to figure out what's actually going on under the hood of, honestly, one of the most volatile tech stocks on the market.
Exactly. And hey, right at the top, just a quick reminder to like the video and subscribe to the YouTube channel. And we really mean this. It is compulsory that you leave your comments and feedback.
Compulsory. We need to hear from you guys to keep these deep dives coming.
Yes, absolutely. But before we get into the weeds, let's just lay down the ground rules.
Right. The disclaimer.
What?
We are analyzing the data here to spark a natural human debate about the stock's mechanics. We are explicitly not providing financial advice.
No financial advice here, just pure analysis. So to figure out if this stock is a hidden gem or a total trap, we really have to start with the actual money flowing in and out.
The fundamentals.
Yeah. Let's look at the price context first, because the whiplash on this chart is severe. Right now, the stock is trading at $27.29.
Which is what, up just a fraction today?
Yeah, up about 0.3% today. But it's currently bouncing back from this brutal 52-week low of $19.48.
And they hit that low just last month, right?
Yeah.
March 23.
Yep, March 23, 2026. But even with that bounce, I mean, it is still miles and miles away from its 52-week high of $62.36.
The fall from that $62 peak has just been staggering to watch.
Truly staggering.
But, you know, if you strip away the stock price for a second and just look at the company as this financial juggernaut, the numbers are almost hard to comprehend.
Oh, they're massive. Walk us through that Q2 data.
Okay, so for Q2 of fiscal 2026, which ended in December of 25, revenue hit an incredible $12.7 billion.
$12.7 billion.
In one quarter.
In one quarter. That is a 123% year-over-year increase. And
Okay.
we aren't talking about like a nimble little software startup just doubling its recurring revenue
Yeah.
back. We are talking about a heavy metal, massive hardware company.
They literally make physical servers.
Exactly. They more than doubled their physical footprint in 12 months. And net income for that quarter sat at $401 million.
Which gives them a diluted EPS of 60 cents, I think.
Right, 60 cents per share. And if we zoom out to the full fiscal year 2025, they showed $21.97 billion in total revenue and over $1 billion in net income.
Okay, let's unpack this. Because there is a glaring contradiction sitting right in the middle of those exact filings you just mentioned.
Oh, the cash flow.
Yeah. You just said they brought in $12.7 billion in revenue in a single quarter. But when you dig into the cash flow statement, their operating cash flow for Q2 was negative.
Yep.
Negative $24 million. How does that even happen?
Well, it's the paradox of hyperscaling hardware, honestly.
I mean, it feels like the market is mispricing SMCI because they're valuing it like a high-margin AI software company, but in reality, they're essentially a high-tech plumbing company.
That's a great way to put it. The pipes are just getting vastly more expensive to build right now.
It's like, okay, think of it like running the most popular restaurant in the city, right? You've got lines around the block, tickets are printing nonstop, everyone is eating.
Business is booming.
Exactly. But you're actually going broke because you're draining all your cash, hoarding these incredibly rare truffles in the back room just to keep the menu going.
Right, you have the revenue, but your cash is completely tied up in the ingredients.
Exactly.
That is the exact mechanism at play here. And the rare truffles in this case are, of course, AI components.
Right. The GPUs.
Yeah, the reason they have negative operating cash flow despite record-breaking revenue is these massive inventory investments.
Because to build an AI server rack, you can't just buy components as you go.
Right.
No, absolutely not. You have to secure thousands of insanely expensive GPUs, advanced memory chips, custom liquid cooling systems, all up front.
So they're tying up billions in inventory.
just to ensure they can actually fulfill the orders that are generating that $12.7 billion in revenue.
Wow.
They're essentially acting as like a low-margin financing arm for the global AI build-out.
And that leads us to the real red flag, right? The thing that is absolutely terrifying Wall Street right now. Their gross margins completely collapsed,
They really did. From 11.8% a year ago.
down to just 6.3%.
Yeah, 6.3.
I mean, dropping from almost 12% to just over 6, that means for every $100 of that massive revenue, they are only keeping about $6.
Right, and that's before operating expenses even kick in.
Yeah. Before salaries, R&D, marketing.
Exactly. When your margin is 6.3%, you have absolutely zero room for error.
None.
A slight delay in a shipping route, a tiny uptick in the cost of copper, or, a localized supply chain hiccup, it wipes out the profit for an entire quarter.
That is so risky.
It is. They are consciously sacrificing profitability to capture market share against massive competitors like Dell and HPE.
So we have to look at their balance sheet then to see if they can actually survive this aggressive pricing strategy.
Right, and the balance sheet actually has some strength. As of the latest data, they have total assets of $14.02 billion.
Okay, against what in liabilities?
Total liabilities of $7.72 billion. And crucially, they have $5.17 billion sitting in cash and equivalents.
Okay, so they have a sizable buffer. I mean, they aren't facing insolvency tomorrow morning.
No, far from it. The balance sheet is structurally sound. But, this is a big bet, that cash burn is a very real, very pressing ticking clock.
Because if your margins are cut in half, that $5 billion buffer gets eaten up a lot faster than investors are comfortable with.
Exactly.
So if the fundamentals are telling two completely different stories, the balance sheet screaming growth, but the cash flow screaming burn, Wall Street has to place a bet on who is lying.
And that anxiety is showing up on the daily charts in a major way.
Let's talk about the traders.
Sure.
How are they navigating this chaos on the charts?
It is basically a wildly volatile battleground right now. If we look at the trend direction, the structure is short-term bearish and medium-term weak.
Even with that big bounce from the bottom.
Yeah, I mean, yes, the stock bounced off that $19.48 low, and we definitely should acknowledge that is a massive 40% bounce from the March lows.
Huge bounce.
But despite that aggressive rally, the stock is still down about 11% over the last month.
Right.
And the moving averages confirm this underlying weakness. The 50-day simple moving average is sitting at $28.65.
And the 200-day is way up there, right?
Yeah, the 200-day SMA is way up at $39.07.
Let's talk about what happens mechanically at those moving averages. Because, for the listener, those aren't just invisible lines on a screen.
No, they are very real barriers.
Right. The 50-day SMA at 28.65 is acting as a heavy ceiling because of pure human psychology.
Bag holders?
Exactly. You have traders who bought in at 30 or 35 bucks a few months ago, watched the stock collapse to 19, and just panicked.
And now that it's creeping back up toward 28, they are desperate to sell just to break even.
Yeah, every time the stock tries to rally, that supply of trapped bag holders just floods the market with sell orders.
That overhead supply is massive, and the 200-day average at 39 is an even thicker wall of resistance.
But, and here's where it gets really interesting, underneath the surface of those heavy ceilings, the momentum indicators are flashing violent signs of life.
The divergence is fascinating.
Right. Like the MACD currently sits at 0.71, which is flashing a rare buy signal from extreme historic lows.
Yep.
And the RSI is sitting at 63.09. And RSI at 63 isn't just a random data point. It basically represents pure exhaustion.
Exactly. It shows momentum turning positive and approaching overbought territory.
It means sellers have been dumping the stock so aggressively for the past month that they've essentially run out of shares to sell.
Right. It creates a vacuum.
A vacuum where even a tiny bit of buying pressure violently spikes the price upward.
And that vacuum effect is precisely why we saw a 40% bounce in a matter of weeks. Traders are looking at the volume and mapping out exactly where the lines in the sand are drawn.
So where are the lines? What are the key levels?
Well, major support is absolutely firm at that $19.48 low.
Okay.
Institutional and retail traders who are looking to play this momentum shift, they're eyeing buy entries right around $25.26.
But with strict stop losses, I imagine.
Very strict, usually right at $18, because they understand the mechanics here. If that March low breaks, the vacuum reverses, and there's no telling how far it could fall.
And meanwhile, the sellers have built those heavy resistance walls we talked about at $35 and $55.04.
Exactly.
So the upside price action is capped by technical walls, but the underlying momentum is pushing up. And then you look at the options data, which just adds a whole new layer of chaos.
Oh, the options market is telling a wild story. The put-call ratio is currently at 0.46.
Okay, explain that first.
A ratio of 0.46 means there is overwhelmingly more volume in call options than in put options. Options traders are surprisingly aggressively bullish right now.
Wait, I have to push back there a little bit. You can't blame this entirely on, like, retail euphoria or Reddit traders buying cheap out-of-the-money calls.
That's fair.
Because a put-call ratio of 0.46 on a stock this size requires massive institutional capital sitting those options and hedging those positions.
Absolutely.
Wall Street is playing this bounce just as hard as retail. Market makers are having to buy the underlying stock to hedge against all those calls, which adds even more upward pressure.
That is a really crucial distinction to make. The institutional money is absolutely involved in the derivatives market here,
Right.
which directly contradicts the broken long-term trend on the chart. And because the options market is leaning bullish, while the long-term chart looks fundamentally weak, it leads us directly into Wall Street's biggest debate right now.
Is SMCI a value trap?
Exactly. Is this an incredibly undervalued generational opportunity, or is it a classic value trap?
The analysts are totally fractured on this. I mean, it's almost comical how divided the professionals are.
It really is. You have, what, 14 to 19 major analysts covering the stock?
Yeah, around there.
And the consensus rating is a hold. But you have to look at the breakdown to see the real chaos.
Let's hear it.
50 to 53% say hold. About 26% say buy or strong buy. And 21 to 24% are at sell or strong sell.
It is a perfect bell curve of confusion.
It really is. And their price targets reflect that entirely. The average target is somewhere around 31.44 to 35.44.
Which implies, like, a roughly 25% upside from where we are today.
Right, but the range.
Mhm.
The lowest target sits at $15 and the highest is $64.
So what does this all mean? How can professionals looking at the exact same balance sheet, the exact same $12.7 billion in revenue, be $50 apart on what a single share is worth?
It's incredible.
Like, what world does the $64 analyst live in versus the $15 analyst?
Well, I think it all comes down to how they are interpreting the forward PE.
Yes, the valuation. Because at a forward PE of just 10.2, the market is basically pricing in a massive earnings contraction.
10.2.
10.2. For a tech company deeply embedded in the AI boom, a 10.2 multiple looks wildly, almost absurdly undervalued compared to historical tech averages.
It looks cheap.
Okay.
But what's fascinating here is that a low PE can be a complete optical illusion.
The value trap.
This is the very definition of a value trap. We have to look at the mechanics of the E in the PE ratio, right? The earnings.
Right.
If profit margins continue to erode like we saw them drop from 11.8% to 6.3%, those projected earnings are going to shrink rapidly.
Because they're making less on every server they sell?
Exactly. If SMCI has to keep cutting its prices to zero margin just to win volume against competitors, the earnings will drop out from under them.
Oh, wow. And if the earnings drop?
Suddenly, that cheap 10.2 multiple skyrockets to 25 or 30, making the stock look incredibly expensive without the actual share price moving a single cent.
That is so dangerous. You think you bought a deep discount tech stock, but you actually just bought a shrinking hardware business.
Precisely.
So since the true value of this stock depends entirely on which of those narratives plays out, we really have to lay out the best and worst case scenarios side by side for you.
Maintaining strict neutrality here, let's start with the bull case.
Let's hear the bull case.
The fundamental bull argument hinges on the sheer, unprecedented physical demand for AI servers. They are guiding for massive revenue of over $40 billion for fiscal year 2026.
$40 billion. It's just staggering to think about that kind of scale.
It is.
And, they have a distinct market leadership in liquid cooling, which, by the way, liquid cooling isn't just a nice feature anymore. It's becoming physically non-negotiable for these next-generation AI chips that just run incredibly hot.
Absolutely, it's a necessity.
Oh.
But beyond the hardware, here is the mechanical catalyst for the bulls. Short interest is sitting high at 16.6 16% of the float.
16%. That is a massive amount of shares sold short.
Huge.
And it creates this dynamic of a tightly coiled spring.
Right.
Because you have upcoming earnings on May 5, 2026.
Yes.
If SMCI reports a massive beat or even just proves their margins are stabilizing at, say, 7 or 8%, all those short sellers have to buy the stock back at the exact same time to cover their positions,
It could trigger a violent short squeeze.
rocketing the price upward right through those moving averages we talked about.
That is the explosive upside potential, the squeeze. But we must counter that with the downside risks.
Right, the bear case. Let's do it.
Beyond the margin erosion we already spent time on, there is a severe client concentration risk. They're heavily reliant on just a few massive hyperscale clients.
Right, the big tech giants.
If just one of those giants decides to delay their data center build-out for a quarter or shifts their orders to a competitor, SMCI's revenue projections collapse overnight.
That's a huge vulnerability.
Furthermore, there's a massive dark cloud hanging over the company regarding legal risks.
Yeah, we have to factor in the DOJ probe. There's a federal probe into alleged export violations and ship smuggling, alongside some co-founder legal issues.
And to be clear, we are impartially reporting the existence of these probes. We aren't taking a side.
Purely looking at this through the lens of market mechanics.
Exactly. But regardless of how those investigations play out, that headline alone forces institutional compliance officers to freeze any buying.
Oh, that makes sense. Because large mutual funds, pension funds, institutional endowments, they have incredibly strict compliance mandates.
They do. They simply cannot allocate capital to a stock that is actively under a major federal microscope, no matter how cheap that forward PE looks.
Which isolates the buying pressure to a very specific demographic, right?
Yes. And this raises an important question about market psychology and the retail trap.
Why do retail traders get trapped here?
Because retail traders often look at the daily chart, see that 40% bounce off the bottom, hear the AI buzzword, see the 123% revenue growth, and they just smash the buy button.
They see a discount.
Right. They completely underestimate the severe volatility ahead, and they underestimate the institutional caution driven by that federal probe.
So they end up holding the bag.
In many cases, retail momentum provides the exit liquidity for institutions that are quietly unwinding their positions.
Wow. But again, I have to challenge the idea that this is just retail getting trapped.
Go ahead.
If you have a short interest of 16%, there are massive hedge funds on the short side who are deeply exposed to a squeeze if this company posts a clean earnings report on May 5th.
That's very true.
It's like a high-stakes game of chicken between institutional shorters, institutional option writers, and retail momentum buyers.
It really is a profound battle of timelines.
So, if you are listening to this, looking at your portfolio right now, trying to figure out your timeline on this, let's synthesize the mechanics.
Let's sum it up.
The short-term outlook for SMCI is a highly volatile, strictly mechanical battleground.
Yep.
You have technical momentum turning positive, options traders leaning heavily bullish, and high short interest creating very real short squeeze potential, especially with that May 5th earnings date looming.
But the long-term perspective is a completely different fundamental equation.
Totally different.
That hinges entirely on surviving margin compression, proving they can maintain profitability against larger competitors, and navigating this federal investigation without catastrophic long-term damage to their hyperscale client relationships.
The divergence between the short-term trading setup and the long-term fundamental reality could not be wider here.
It really is a stock where you have to know exactly which game you are playing and exactly what your timeline is before you allocate a single dollar.
Absolutely. And we want to reiterate that our goal today was purely an exploration of the data, the underlying market mechanics, and the psychology driving those charts.
Right. We are analyzing the field. We are not providing financial advice.
No financial advice. But if you're enjoying cutting through the noise with us and breaking down these complex market mechanics, hit that like and subscribe button right now.
Please do.
And leaving your feedback in the comments is absolutely compulsory. We need to know what you think.
We want to hear your thesis.
Yeah. Are you looking at a coiled spring ready for a historic short squeeze, or are you looking at the ultimate value trap? Drop it in the comments.
And I will leave you with this final provocative thought to chew on.
Let's hear it.
We're watching a company at the absolute epicenter of a generational technological shift.
The AI boom.
Right. If a hardware giant can grow its revenue by 123%, dominating the physical infrastructure space, but watch its profit margins get cut in half during the biggest AI gold rush in history. What exactly happens to them when the gold rush finally slows down?